So the other plain vanilla option, as we like to call them, is the put option. So we've discussed calls, now we're going to talk about puts. So again, we talked about being long a stock and how a call is the right but not obligation to buy a stock. A put is the right but not the obligation to actually sell a stock. So again, if you went short a stock, i.e. you sold a stock at 100, your payoff profile would look like this. So that's the stock price. If you sold it at 100 and the stock price went down to 90, you would make money. You'd make 10, which is the difference between 100 and 90. If the stock price went up to 110, then you would lose 10. Okay, so same story, just like if you had bought a stock at 100. In this case, if you were short the stock, that's how the P&L profile is. It's a linear profile, as we discussed, if you go long a stock or short a stock. Now, what do put options allow me to do? They take out this part of the payoff. So if I bought a put option and the stock went above 100, I would not lose money because remember, I've got the right but not the obligation to sell. So I wouldn't actually be short the stock when the stock rallied. But if the stock went down, I would make money because I would sell it at 100 and I would ride up that payoff. So put options are a bearish position. You know, people who are buying these are doing it to benefit from the market going down. As you can see, the P&L goes positive when the price goes down. So you can also think of put options like portfolio insurance, right? That's kind of how the market views put options. You would buy a put option and again, you have to pay a premium for it. So the payoff, 0 along here and positive here. The only way you get that is by paying a premium. Let's take an example. This 100 strike put costs us 5. Then the true P&L would look like this. You would have spent your 5, which is here. Anywhere above 100, you will lose 5. Anywhere below 100, you'll start making the money back, and your break-even point will be 95, which is 100 minus the premium that you spent on the put. So in this case, if you felt like spending 5 was worthwhile to get protection for the stock to go below 95, then that's what you would do. It'd be like paying an insurance premium of 5 to protect you from the stock going down. And that's how it works. So people in the market buy put options on major indices usually to protect their entire portfolio, right? So they buy crash protection and portfolio protection. And because of that demand, that creates a strong demand for puts in the market, particularly downside puts in the market. And that's one of the most heavily traded instruments that is out there in the options market, and what institutions and portfolio managers do with put options. They generally buy them to protect their portfolios. And that makes the price of put options relatively more expensive, just like we talked about calls being oversupplied. That's what makes call options cheap, particularly upside call options. Now, downside put options are relatively more expensive because there's a natural demand for downside puts. And that's calls and puts. Thanks so much for watching. Hope you found this video useful. If you have any questions, feel free to write them in the comments below. And to see more short and snappy video tutorials like this one, you can subscribe to my channel. For further information about my training services, please visit optionsinsight.com.